Hi everyone! My topic is the chapter 13, which is capital structure concepts. Before I proceed, let us define first what is capital structure. Capital structure is defined as the amount of permanent short-term debt, long-term debt, preferred stock, and common equity used to finance a firm. In contrast, financial structure refers to the amount of total current liabilities, long-term debt, preferred stock, and common equity used to finance a firm. Thus, capital structure is a part of the financial structure, representing the permanent sources of the firm's financing. To illustrate the capital structure concept, suppose that Baker Oil Company currently has $10 million in permanent short-term debt, $40 million in long-term debt outstanding, $10 million in preferred stock, and $40 million in common equity. Baker's current capital structure is said to be 50% debt, 10% preferred stock, and 40% common equity. Thus, the capital structure pertains to the permanent debt, preferred stock, and common equity portion of the balance sheet. The emphasis of capital structure analysis is on the firm's long-range target capital structure, that is, the capital structure at which the firm ultimately plans to operate. Capital structure decisions and maximization of shareholder wealth. What is meant by a firm's optimal capital structure? The optimal capital structure is the mix of debt, preferred stock, and common equity that minimizes the weighted cost to the firm of its employed capital. At the capital structure where the weighted cost of capital is minimized, the total value of the firm's securities is maximized. As a result, the minimum cost capital structure is called the optimal capital structure. The amount of debt contained in a firm's optimal capital structure is often referred to as the firm's debt capacity. The optimal capital structure and accordingly the debt capacity of a firm are determined by factors including the business risk of the firm, the tax structure, the extent of potential financial distress, and agency cost, and the role played by capital structure policy in providing signals to the capital markets regarding the firm's performance. Assumptions of capital structure analysis. The analysis that follows is based on some important assumptions. First, assume that a firm's investment policy is held constant when we examine the effects of capital structure changes on firm value and particularly on the value of common stock. Second, assume that the investments undertaken by the firm do not materially change the debt capacity of the firm. Two elements of risk are primary considerations in the capital structure decision: business risk and the financial risk of a firm. There are 7 factors influence a firm's business risk. But before that, let us define first what is business risk. Business risk refers to the variability or uncertainty of a firm's operating income, or the EBIT. EBIT stands for earnings before interest and taxes. The first factors influence a firm's business risk is the variability of sales volumes over the business cycle. Firms such as Delta Airlines, whose sales tend to fluctuate greatly over the business cycle, have more business risk than firms such as Lois companies. For example, 2004, financial analysts were forecasting that Lois would have record high sales and earnings. In contrast, analysts were expecting Delta Airlines to have substantial losses in 2004. Second, The variability of selling prices. In some industries, prices are quite stable from year to year, or the firm may be able to increase prices regularly over time. Third, the variability of cost. The more variability there is in the cost of the inputs used to produce a firm's output, the greater is the business risk of that firm. For example, airline companies such as Delta and United have been affected significantly by the volatility in the price of jet fuel. Fourth, existence of market power. Firms such as General Electric that have greater market power because of their size or the structure of the industries in which they compete often have a greater ability to control their cost and the price of their outputs than firms operating in a more competitive market environment. Therefore, the greater a firm's market power, the less its business risk. Fifth, the extent of product diversification. The more diversified a firm's product line, the less variable its operating income is likely to be. For example, IBM offers a broad array of products and services, including computer chips, personal computers, mid-range of computers, large mainframe computers, computer software and systems, and financing. The level and rate of growth. Rapidly growing firms such as Amazon often experience great variability in their operating earnings. Rapid growth causes many stresses on the operations of a firm. And lastly, the degree of operating leverage or DOL. Operating leverage involves the use of assets having fixed cost. The more a firm makes use of operating leverage, the more sensitive EBIT will be to changes in sales. The degree of operating leverage is the multiplier effect resulting from a firm's use of fixed operating cost. The DOL is defined as the percentage change in EBIT resulting from divided by a given percentage change in sales or the output. Business risk. Systematic or unsystematic risk. Business risk possess elements of both systematic risk and unsystematic risk. Some of the variability in operating income that results from business risk cannot be diversified away by investors who hold a broad-based portfolio of securities. For example, variability attributable to business cycle behavior is clearly systematic. In contrast, the variability attributable to specific managerial decisions, such as product line diversity, is primarily unsystematic. When analysts attempt to assess the specific total risk of a firm, they must consider both systematic and unsystematic components of that risk. A firm may encounter operating difficulty because of both economic-wide factors that impact its operations and because of unique decisions made by its management. Financial risk and financial leverage. Financial risk refers to the additional variability of earnings per share and the increased probability of insolvency that arises when a firm uses fixed cost sources of funds such as debt and preferred stock in its capital structure. While financial leverage is the use of fixed cost financing sources. The use of financial leverage results in an increase in perceived risk to the suppliers of a firm's capital. To offset this increased risk, higher returns are required. Financial risk, systematic or unsystematic risk. Financial risk, like business risk, contributes to both the systematic and unsystematic risk of a firm's securities, to the extent that the use of financial leverage magnifies variations in operating income that come about because of unsystematic risk factors. Financial leverage contributes to the unsystematic risk of a firm's securities. Capital structure without a corporate income tax. In 1958, two prominent financial researchers, Franco Modigliani and Merton Miller, showed that the value of the firm is independent of capital structure given perfect capital markets and no corporate income tax. Also showed that the optimal capital structure consists entirely of debt if a corporate income tax exists. In the no-tax case, the cost of debt and the overall cost of capital are constant regardless of a firm's financial leverage position, measured as the firm's debt-to-equity ratio. Support the theory by arguing that a process of arbitrage will prevent otherwise equivalent firms from having different market values simply because of capital structure differences. Arbitrage is the process of simultaneously buying and selling the same or equivalent securities in different markets to take advantage of price differences and make a profit. Arbitrage transactions are risk-free. For example, suppose two firms in the same industry differed only in that one was levered, that is, it had some debt in its capital structure, and the other was unlevered, that is, it had no debt in its capital structure. If the theory did not hold, the unlevered firm could increase its market value by simply adding debt to its capital structure. However, a perfect capital market without transaction cost, argued that investors would not reward the firm for increasing its debt. The argument is based on the arbitrage process. If one of two unlevered firms with identical business risks took on some debt and the theory did not hold, its value should increase, and therefore, so with the value of its stock. Suggests that under these circumstances, investors will sell the overpriced stock of the levered firm. Therefore, can conclude that the market value of a firm is independent of its capital structure in perfect capital markets with no income taxes. Let us take a look at the table of the capital structure with a corporate income tax. The table contains the financial data on two firms, Firm U and Firm L, that have equal levels of net operating income, or the EBIT, which is $1,000, and the operating risk, and differ only in their capital structure. Firm U is unlevered and Firm L is levered, with a perpetual debt of $2,000, having a coupon rate of 5% in its capital structure. We assume that the income of both firms available for stockholders is paid out as dividends. As a result, the expected growth rate of both firms is zero because no income is available for the firms to reinvest. The present value of both firms is calculated as market value of the firm equals market value of equity plus market value of debt, or the E, where E and B stands for the respected market values of equity and debt in firm's capital structure, where D is the annual amount of dividends paid to the firm's stockholders, while I is the interest paid on the firm's debt, and where the key is the return required on common equity and key D is the return required on debt. The required rate of return on the common equity for the unlevered firm, which is firm U, is 10% because of the increased financial risk associated with the $2,000 in debt financing. The required rate of return on the common equity of the levered firm, which is firm L, is 11.25%. The required return on debt, or the key D, is assumed to equal the coupon rate on the debt or the interest. I, for firm U, the present value of the expected future cash flows is $10,000, which is calculated as follows. The market value of firm U is equal to $1,000 over 10%, which is equal to $10,000. For firm L, the present value is also $10,000 as calculated. Market value of firm L is equal to $900 over 0.1125 plus $100 over 0.05. 900 over 0.1125 is equal to $8,000 plus 2,000, which is come from $100 over 0.05. $8,000 plus $2,000 is equal to $10,000. Thus, the market values of firms U and L are equal. This example shows that the market value of the firm is independent of capital structure, assuming that the theory holds and no corporate income tax exists. Capital structure with a corporate income tax. The relationship between capital structure and fair market value is considered, assuming that a corporate income tax exists. Please see the attached table. The table shows financial data for an unlevered firm U, and a levered firm L, assuming a corporate income tax rate of 40%. The total income available to the security holders of firm U is $600, and assuming a cost of equity capital equal to 10%. The value of firm U is calculated using this equation. Market value of firm U is equal to $600 over 10% is equal to $6,000, because interest paid to debt holders is a tax deductible expense. The total income available to the debt and equity security holders of firm L is $640. This amount is greater than the $600 available to the firm U equity security holders by $40. The $40 amount is the tax shield caused by the tax deductibility of the interest payment. The annual tax shield amount is calculated using the equation. Tax shield amount is equal to I times B times T, which is I is the 5% times the B is the $2,000 times the the corporate income tax rate, which is 40%, is equal to $40. Other considerations in the capital structure decision. First is the personal tax effects. Personal tax effects: in the absence of financial distress, cost, and agency cost, the firm should attempt to minimize its taxes by employing the maximum amount of debt. Second is the industry effects. There is an optimal capital structure for individual firms, although firms may deviate from their optimal leverage targets. Over time, they appear to take actions that close the gap between actual and target capital structure ratios. And the third one is the signaling effects. Officers and managers of a company, as insiders, have access to information about the expected future earnings and cash flows of the firm that is not available to outside investors, which is called the asymmetric information. And the fourth one is the managerial preference effects, or the pecking order theory. In the pecking order theory, there is no particular optimal capital structure for a firm. Companies prefer internal financing to external financing, and given that external financing is necessary, they prefer to issue debt securities first and then equity securities only as a last resort. That would be all, and thank you.